Hi, I'm Adam Tarr with Citywide Real Estate in Phoenix, Arizona. I've worked a lot with Canadian citizens in the past to help them purchase properties here in the Phoenix area. As a matter of fact, I have gone to a couple of real estate conferences in Canada over the past couple of years and even held my own seminars in Canada for people who are looking to purchase here. So there are a lot of different things that people have questions about. What are the tax implications? How easy is it to buy? All sorts of things. So at this point, I'm going to cover one aspect of the tax implications. And before I mention anything, I should say, no matter what I say, these are generalities. You should talk to your accountant or tax professional to see what your particular circumstances will mean for your purchase. So with that in mind, here are some general aspects. Basically, let's use a very simplified example. Suppose you purchase a property for $100,000 and sell it a few years later for $200,000. Forget about basis and other costs of sale. Let's just make it simple. There's a $100,000 profit. Well, there is a capital gains tax. If you held it for a few years, you'll have a long-term capital gains, which at this point is 15% due to the IRS. So in this example, that would be $15,000. Additionally, there is a tax treaty between the US and Canada. So if the tax that you would have due in Canada is higher, really that $15,000 will be credited towards the total amount that you have due to the CRA in Canada. Again, talk with your tax professional to see how you can best determine where those monies need to be paid and really what your total liabilities are. Now, with that in mind, I'll also mention how it's handled in the US. We're talking about sale of a property and the income generated from that, not income generated by rentals, which I'll cover at another time. There is an act in the US called the Foreign Investment in Real Estate Property Tax Act. It was put into place because too many people were skipping out on paying their taxes when they lived in other countries. The idea behind that is when a property is sold, the buyer is required to withhold 10% of the total sale price. Now in this example that I provided, the sale price being $200,000, the buyer would withhold, and it's usually title companies doing that, they would withhold $20,000. Once the seller has provided proof that their tax burden has been paid, then any balance remaining will be paid back to them. So that'll give you a general idea. There's a lot more to it, of course, but that's probably the most common question I get, and I'm getting that a lot right now. We're headed back into the fall, and people are starting to come down and take a look so they can get their properties for the colder winter. But if you have any questions, I have a section on my website that addresses it, and please feel free to give me an email or a call so that I can answer questions for your circumstances. Again, my name is Adam Tarr, Citywide Real Estate, Phoenix, Arizona. Thanks for watching. Have a great day and make it great for someone else as well.